Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, easy money. It's a hell of a drug, isn't it? I've been saying for quite a while that I didn't think that the gold and silver rally were anywhere near finished, and yesterday demonstrated that reality in spades. And it actually started on Friday when gold and silver got a bit of a boost after Federal Reserve Chairman Jerome Powell went dovish during his Jackson Hole speech, signaling the likelihood of a rate cut in September. And during the speech, the Fed chair acknowledged that the downside employment risks, quote, may warrant adjusting our policy stance from its, quote, current restrictive setting. Now, of course, lower interest rates are considered bullish for metals, given that they are non-yielding assets. So basically, that means a lower interest rate environment means that there's a lower opportunity cost for holding them. And in your conventional investment wisdom, that means it's a good time to hold both gold and silver. But I think there's really more to it than that. I think a lot of people understand that rate cuts are inherently inflationary. And in fact, I was looking at some of the news articles this morning, and there were several mentions of worries about increasing inflation pressure. So that knowledge is out there. And by the way, monetary policy is not restrictive right now, despite what Jerome Powell told you, at least not from a historical standpoint. It's loose. And it's actually been loose throughout the entirety of the rate tightening cycle. Policy definitely got tighter. It almost even got tight from a historical standpoint, but it never did. And now it's about to get even looser. And, you know, there's already plenty of inflation baked into the system. I've mentioned several times that the money supply has been increasing for well over a year. That is, by definition, inflation. And rising prices, whether it be consumer prices or asset prices, that is a symptom, a byproduct of this monetary inflation. So we're in an inflationary environment now. And now we're going to add inflation to inflation. And when that happens, you want to have an inflation hedge. And I think that while you don't hear this kind of reporting typically in the mainstream, I think a lot of people are aware of that. And I think that's continuing to drive investors into gold and silver as they're seeking to figure out a way to shield themselves from the rapid devaluation of fiat currencies. So on Monday, gold set a new record in overseas trading. It briefly eclipsed $3,500 an ounce. And of course, Americans were celebrating labor by not working. But on Tuesday, the metals really took off, and we saw gold knock on the door of $3,550. It closed above $3,500 yesterday for the first time ever. And this morning, when I started recording just a few minutes ago, gold was trading at $3,562 and change an ounce. So an all-time record high, and we're up like 60, 70 bucks over the last 24 hours or so. And then, meanwhile, silver hit a 14-year high yesterday. It traded over $41 an ounce. It's back over that level this morning. I think it was $41.15 when I started recording the show. And keep an eye on silver, by the way. I'm seeing more and more analysts projecting a new record above $50 an ounce before the end of the year. And I'm going to be honest, I did expect silver to set new all-time highs, but I kind of thought it would be early next year. So this is happening much quicker than I expected. But with prices solidly above $40 an ounce, you can make a decent case, because that $40 was really kind of the final hurdle, the final big, strong resistance area on the silver chart. And as I said, we're a buck over that now. So we could see a relatively quick run up to $50 an ounce. And I've been talking about silver a lot on the show. If you're a regular listener, you know that the silver-gold ratio, or the gold-silver ratio, is still historically wide, which indicates that silver is still underpriced compared to gold. It's got a long way to go. And we also have supply and demand dynamics. We've had supply pressures and increasing demand, especially in the industrial sector. And now we're starting to see a pickup in investment demand. I'll link to an article in the show notes page by Jesse Colombo, who makes the case for silver. Jesse, by the way, is a really good technical analyst, and you can find his work on our website at moneymetals.com/news. And, there were other factors in play during the metals rally yesterday. There was a rush to safe havens as a judge held that most of Trump's tariffs were illegal. That ruling came out on Friday. Now, of course, there's still more legal wrangling to go. But, we can debate whether the president has power to unilaterally levy tariffs. But the bottom line is that this ruling has injected yet more uncertainty into the economy. We've got a lot of volatility, and people are looking for safe havens in that kind of risk-off environment. And interestingly, the 10-year Treasury yield was up yesterday. In fact, all of the Treasury yields are up. And this indicates that safe haven investors weren't all that interested in U.S. debt. Now, I've talked about this drift away from U.S. bonds as a safe haven buy before. This is a really significant shift that I think a lot of people have missed, because historically, U.S. bonds have been that safe haven. They've been right there with gold. You get a crisis, you get people trying to avoid risk, you have turmoil in the markets, people turn to U.S. bonds. They're not doing that. And I think this really supports the view of Jim Grant and a number of other analysts that I really respect, who believe we are entering into a secular bear market for bonds, where we're going to see a long period, and we're talking years, even decades, where interest rates are higher than they had been, and bonds are generally spurned by the marketplace. And, when you think about it, it kind of makes sense, because if you look back over the last 20 years, go back to 2008, and really before that, we've had this long period of historically low interest rates. We had almost a decade of 0% interest rates, and then they tried to ratchet them up a little bit in 2018, 2019. They couldn't do it. And then we had the pandemic. We went back to zero again. So what we've had over the last couple of decades is really the anomaly, right? 0% interest rates are not normal. That's not normal in any way, shape, or form. But I think a lot of people who kind of came into, the markets and started their careers in finance during the 2008 financial crisis, they think this is normal. This is what they've known. So when they see 4 or 5% interest rates, they're like, oh my gosh, that's nothing, right? Zero is the anomaly. But I think another factor behind the rally in metals and this flight to safe haven that we're seeing is this is generally a season of strong gold demand. We have a wedding and festival season that's getting underway in India, and we've had a historically good months in September and October for gold, just kind of from a historical trend basis. And then September has been kind of known for a bad month for stocks, right? September, October, fall, kind of a time when we've seen some turmoil in the markets. Now, this may be a self-fulfilling prophecy, but that doesn't change the impact, right? If people are worried and they're expecting, September is usually a bad month for stocks, maybe we better, shield ourselves, hedge ourselves a little bit. Let's get some gold and silver. I think that's also part of what's going on. So we've got all of these dynamics that are kind of working together that have sparked this kind of new leg up in what I still believe is going to be a very long-term bull market for both gold and silver. And I really think that the bottom line is that a lot of people in the world are recognizing the fact that fiat currencies are failing, right? They see the value of their money declining every single day. They see that inflation isn't going away, right? They're talking about, we've done so good with inflation. It's still well above the mythical 2% target. And as I've said on the show many times, 2% is still quite a bit of inflation, right? And that's on purpose. This is the policy. The policy is to devalue your money. So I think a lot of people are recognizing that, and more people are trying to shield their wealth, protect themselves by holding real money, gold and silver. And, while we're on that subject, did you know that you can actually hold physical gold and silver in an IRA, in a self-directed IRA? A lot of people don't know this, and it's a way that you can diversify your IRA and, again, do exactly what people are trying to do. Protect the devaluation of your money, the devaluation of fiat by holding that real money in your retirement plan. You definitely don't want to hold cash over the long term, right? Because your cash is devaluing at least 2% every year on purpose, and really more than that in reality. So you can do that. And if you want more information on how you can hold gold and silver in your IRA, Money Metals can help with that. So give us a call. The number is 800-800-1865, or you can just go to moneymetals.com and find information on our website. I'll link to an article in the show notes page that gives more information on exactly what you have to do to hold physical gold and silver in your IRA account. But a lot of people, again, don't know about this. And I think it's an important thing to do. If you're using an IRA to save for retirement, you want to have the inflation hedge in place. You want to have that physical gold and silver within that IRA. You can do it. It's not hard. So get that information today. And that's something I think you should definitely look into. So check that out when you get a chance. But anyway, as both gold and silver kind of take off again, I wonder if U.S. investors are starting to jump on the bandwagon. I've talked before about the fact that Americans have largely been absent during this gold bull run. It's been driven primarily by central bank buying and Asian investment. And the same is true for silver. I did an article that you can find over at moneymetals.com/news, and I'll link to it on the show notes page as well, that kind of goes over investment demand for silver. And like gold, we've seen robust demand in Asia, especially India. We've seen a recovering silver market in Europe over the last 6 or 8 months. But here in the U.S., we've seen investors taking advantage of higher prices and selling to take a dollar profit. And it's very similar to the dynamic that we've seen in the gold market, where U.S. investors have also remained on the sidelines. And this isn't just speculation. The data bears this out. According to the Silver Institute, retail silver investment is down about 30% in the U.S., which is kind of crazy when you think about it. We've had silver on this incredible run. I think it's up some 30+% this year, and yet people are selling. And maybe there's this expectation that the bull run is over. I don't think it is. We've talked about that before, but that's definitely what's going on. The rest of the world is carrying this bull market, and you have to wonder, when are U.S. investors going to hop on that bandwagon? And when they do, I think it's going to continue to pressure the prices up, right? At some point, American investors are going to see the writing on the wall, and they will hop on that bandwagon. Now, I've asked several people over the last several months why they think Americans seem to be generally uninterested in gold and silver. And the most common answer I get is that it's primarily a cultural thing. And it is true. Asians they value gold. It is interwoven into their culture, especially in a place like India. But I think that the mainstream financial media in the United States actually contributes to the American mindset, right? If they're not bad-mouthing gold on Fox Business and CNBC, they're just ignoring it. And since it's hard right now to badmouth the best-performing major asset this year, they're just opting to ignore it. I watched the CNBC X feed yesterday, and as gold surged to a new record, there was exactly one mention of gold in their feed, and that was in the context of a Bitcoin rally. This is typical. Gold just kind of goes under the radar here in the United States. Everybody is focused on stocks, and it makes sense, I guess. If you look at the makeup of your typical, CNBC or Fox Business, these panels, they're all stockbrokers. So they have a vested interest in pumping the stock market. You've seen a lot of Bitcoiners on the media. Gold bugs don't get to be on TV because, we're just weirdos and we're just sitting over here watching our investment go up and up and up. But, they can ignore it if they want to, I guess. But it is just kind of a weird dynamic. And, in a way, it's almost as if there's this concerted effort by the powers that be to downplay the value of gold and silver. And I think that's because they're real money. They want you to be fully invested in the fiat system. They want you all in on dollars, right? They don't really care if inflation is eroding away your wealth. No skin off their back. They just want you to keep buying stocks and trusting your government. And when you really start to see the monetary malfeasance, starts to get hard to trust your government. And that's not something government people want. And I really do. I think there's some of that that's kind of built into the system. There's this bias against real money because they have to prop up this fiat system because the fiat system is shoddy and shaky. It's like a dilapidated house that's not up to code. And, they don't want you to realize that. So anyway, that's just my speculation. Anyway, there was another bit of significant news last week that I want to dig into, and it supports those of us who remain bullish on gold despite the recent big gains. And again, I've said that I don't think that this bull market is anywhere near over. I think we're looking at a secular bull market in gold. Technical analysts tend to agree with that. And one of the things that's going on is for the first time since 1996, foreign central banks now hold more gold than U.S. Treasuries. And I think this is a continued reflection of de-dollarization. Crescat Capital macro strategist Tavi Costa highlighted the crossover moment in a post on X, and he showed a graph, and it shows that gold has gone above U.S. Treasuries in terms of global reserve holdings. And he said, quote, "This is likely the beginning of the most significant global rebalancings we've experienced in recent history." I don't think he's overstating that. I think it's very true. When you start talking about the dollar losing its status as the reserve currency, that's big news, right? It's huge. And I think a lot of people are just kind of, whatever. Yeah, there's some de-dollarization out there. I don't think people grasp the significance of this because the fact of the matter is the fact that the U.S. has had the privilege of issuing the reserve currency has really allowed it to borrow and spend, the government to expand to the extent that it has. If the dollar was not the reserve currency, they wouldn't be able to do it. So this is an extremely significant event, but it's playing out very slowly. It's kind of like the frog boiling in the water. It's not like we're seeing this currency collapse. It's this drip, drip, drip erosion of the power of the dollar. And, if you're a regular listener to the show, you know that central banks have been aggressively adding gold to their reserves over the last 3 years. We've had over 1,000 tons of central bank gold buying 3 straight years. And to put that into some context, central bank gold reserves increased by an average of just 473 tons annually between 2010 and 2021. So what we've seen since then is more than double the amount of central bank gold buying. And at the same time, dollar reserves have been falling. As of the end of last year, dollars made up about 57.8% of global reserves. Still a lot, more than half, right? But it is the lowest level since 1994. It represents a 7.3% decline over the last decade. And if we go back to 2002, dollars accounted for about 72% of total reserves. So we see this shrinkage in demand for dollars. A recent JP Morgan note said that this reveals the waning dependence on the US dollar in trade that is being reflected in the gold market. And then on the other side of the coin, which is really kind of the same coin, right? There's this sagging demand for U.S. Treasuries. And I've already mentioned the fact that Treasury yields rose yesterday, even with the expectation of rate cuts and a pivot to safe havens. That should have boosted treasuries. We should have seen yields drop. It didn't happen. So definitely something to note, right? So why are so many countries spurning the dollar? Well, many are concerned about the weaponization of the U.S. currency. An article published by the Atlantic Council put it this way, quote, "Central banks that are worried about getting sanctioned, want to protect themselves from a potential global financial crisis, or both, have been stacking up gold at record levels." And of course, there are also growing worries about the U.S. government's fiscal irresponsibility. Even if people here in the United States kind of shrug and say, whatever, this is what we do, we borrow and spend, people in the rest of the world are starting to sit up and take notice that maybe this is not a sustainable fiscal trajectory. Earlier this month, the national debt pushed above $37 trillion. Actually, that was last month. We're in September now. But there's no sign that the borrowing and spending is going to slow down anytime soon. Earlier this year, analyst Artis Shepard called the sagging demand for U.S. Treasuries, quote, red lights blinking. He said, quote, the bond market is sending a message to the U.S. government that its spending is out of control and the reserve currency privilege it has abused for the last 80 years is running out. That really is the key. He just summed it up perfectly in that one sentence. And it makes sense, right? If you really think about it. I mean, if I told you that my buddy was $100,000 in debt and he was taking out new credit cards to pay off his old credit card balances, but he wanted to borrow some money, would you be interested in loaning him some? Probably not, right? That's basically where we are here in the United States. The U.S. government is your drunk uncle with a gambling problem and a credit card that is rapidly approaching the limit. And everybody's kind of looking at him and going, maybe we shouldn't loan him any more money. Now, I want to be really clear. I'm not saying that you're going to be reading about the demise of the dollar tomorrow, right? It's more of a slow burn. It's like water eroding a rock. It takes a long time for water to erode rock. But make no mistake, the erosion is occurring. And once the rock is gone, there ain't no putting it back. That said, the dollar is not in any danger of collapsing or even losing its reserve status, at least not yet, in my opinion. However, even a modest de-dollarization spells trouble for the federal government and the U.S. economy. Because in a nutshell, the United States needs the world to need dollars. The U.S. depends on this global demand for dollars, supported by its reserve status, to underpin its massive government. The only reason that Uncle Sam can borrow and spend and run massive budget deficits to the extent that it does is the dollar's role as the world's reserve currency. It creates a built-in global demand for dollars and dollar-denominated assets, and this absorbs the Federal Reserve's money creation and helps maintain dollar strength despite the Federal Reserve's inflationary policies. If the dollar was not the reserve currency, if everybody didn't want and need dollars, we would have way too many dollars floating around because the U.S. government keeps creating them. So the reserve status is kind of like the sponge that soaks up dollars and allows our government to continue to borrow and spend without us facing the level of price inflation that we would if this was going on in a normal environment. Wolf Street is an analyst that I really like. And Wolf Street summed up the risk the U.S. faces as the dollar status continues to erode. Quote, the status of the U.S. dollar as the dominant global reserve currency has helped the U.S. fund its twin deficits. And he's talking about the trade deficit and the budget deficit, and thereby has enabled them. The huge fiscal deficit every year and the massive trade deficit every year. The reserve currency status comes from other central banks, not the Fed, having purchased trillions of USD denominated assets such as Treasury securities, other government securities, corporate bonds, and even stocks. The dollar's status as the dominant reserve currency has been crucial for the U.S., and as that dominance declines ever so slowly, risks pile up ever so slowly. And remember the old saying, things happen slowly and then all at once. So while the threat isn't immediately, a slowly growing pile eventually turns into a giant pile. But again, even a modest de-dollarization will have significant impacts. If the world needs fewer dollars, they will begin to return to the U.S. The dollars are going to come home, and that's going to cause a dollar glut. This is what is known as inflation, right? It will increase inflationary pressure domestically as the value of the U.S. currency further depreciates. In the worst case scenario, the dollar could collapse completely, leading to hyperinflation. I don't really think that's going to happen, but that doesn't mean it's not a problem. And it could. That is on the table. But even this kind of evolution that we're seeing toward what a lot of people are calling a multipolar world in terms of currencies, that's a problem for the U.S. Again, the U.S. needs demand for dollars. So, again, this is why so many central banks are buying gold. They recognize that the dollar is eroding. They recognize the inherent risk in this fiat currency. And all fiat currencies share this risk, by the way. It's not just dollars, it's euros, it's yuan, it's yen, whatever currency you want to come up with. Any fiat currency is subject to this same problem. It is amplified in the United States because the dollar is the reserve currency. So, I want to touch on one more thing before I end this show. This is a little bit of a subject change, but I think it's interesting. Over the last several weeks, I've seen a bunch of stories about this massive gold discovery in Uganda. And you may have seen the reports. They say that this exploration survey that they did indicates a deposit of 31 million tons of gold ore. They say it would yield approximately 320,000 tons of refined gold valued at about $12 trillion. Now, to put that into some perspective, according to the World Gold Council, about 2,116,000 tons of gold have been mined throughout history. So we're talking about an ore field, an underground reserve that is bigger than all of the gold that has ever been mined. So, in other words, the Ugandan government claims that it has discovered gold reserves that are 56% larger than the total amount of gold mined ever. Now, as I put it in that context, does it seem a little suspicious? Because it should, and it is. I'm not sure why this story is suddenly making the rounds again. The initial report actually came out back in 2022. At the time, Reuters reported that an official with the Ugandan Ministry of Energy and Development reported the discovery. And quite frankly, it just doesn't add up. And when I saw this story, I intuitively thought, this doesn't add up, right? And so did a guy named Luke Burgess. He ran the numbers and he published an article over on outsiderclub.com. And basically reveals that this story has to be BS. Given the amount of refined gold the Ugandans claim they could produce from the ore, the average ore grade would have to be more than 10,000 grams per ton. Now, that's probably meaningless unless you're somebody that's kind of deeply into the mining sector. But according to Burgess, the highest graded gold mine at the time, this is in 2022, was Angnico Eagles Fosterville mine in Australia. Before the pandemic, the average grade was around 40 grams per ton, right? So they're saying that they've got this ore that's going to be 10,000 grams to ton, and yet the best ore in the world was only 40 grams per ton. During the first quarter of 2022, that actually dropped to 28 grams per ton. And even then, it was still the highest graded mine. So Burgess sums it up. He says, so the absolute highest graded gold mine in the world right now is operating with an average head grade of under 30 grams per ton. And the Ugandan government is saying its country has a massive ore resource with an average grade of over 10,000 grams per ton. Unbelievable, he says. Yes, it is. Unbelievable. Burgess said that if there was such a discovery, quote, there would be visible gold absolutely everywhere. Gold would be spilling out of the rock. You wouldn't be able to walk without stepping on gold. Obviously, that's not the case. So this story is obviously exaggerated, if not fabricated. So why would the Ugandan government make up such a story? Well, I mean, they might have made a mistake in the reporting. Maybe they meant it was going to yield 320,000 ounces of gold, which would make a little bit more sense. But I don't know, maybe something else is going on, right? The answer may well lie in the very first sentence of the Reuters report that came out, the initial report on this. Quote, it, meaning the Ugandan government, wants to attract big investors to develop the sector hitherto dominated by small wildcat miners. So the Ugandan government wants to attract big investors to mine gold in the country. How do you do that? You tell them there's a whole bunch of gold there. And guess what? I ran across this article, an article on miningtechnology.com reporting on the opening of Uganda's first large-scale gold mining. And buried in the article was this tidbit. Quote, furthermore, a new mining law enacted in 2022 allows the Ugandan government to take a mandatory 15% fee carry stake in all mining operations within the country. And what year was this immense Ugandan gold discovery? 2022. So I'm not saying that the Ugandan government lied to incentivize big miners to come into the country, but I ain't saying they didn't either. And this raises another question. Why does this story that seems sketchy, when given the slightest bit of thought? Again, I'm not really into the mining sector. When I saw it, it just was like, this doesn't quite make sense. Why does it keep getting traction out there on social media over and over again? I mean, it could be that just people are drawn to fantastic stories, and a $12 trillion gold deposit is clearly fantastic, but there could be more to it. And I'm completely speculating here, all right? Talking off the top of my head. But it could be that people who would prefer you not to be so bullish on gold keep recycling this tale. I'm talking about Bitcoin pumpers or maybe government actors who want you to believe gold isn't really all that valuable. After all, if we have a $12 trillion gold discovery, gold isn't as scarce as we thought, and therefore maybe it's a little less value. Maybe you don't really want gold. Maybe gold's not the best money. Maybe you want Bitcoin instead. Maybe you want to just rely on the good old dollar. Right? In fact, when I kind of look at it, a lot of stories along this same line seem to get a lot of play. For instance, the fact that there's apparently an asteroid containing trillions of dollars of gold floating out in space. That one pops up a lot. Never mind that there's no way to mine that gold. But the story is often used to point out that gold is more abundant than we realize and therefore less valuable because, of course, gold is valued partly because it's scarce. But it is scarce, right? And then there's the recent headline declaring that scientists have turned lead into gold. Now, of course, according to researchers' calculations, it would take about 33.9 billion years to create 1 ounce of gold at the rate they created it. But, you get that story out there. Oh, we can make gold. Gold is less valuable. Yes, it is true. There is a lot of gold in the universe. Heck, there's a lot of gold in the earth, right? From what I understand, like the molten middle of the earth, there's tons of gold there, but you can't get to it. And if you can't get to it, it may as well not exist, right? It's the ability to mine it that's important. And the fact of the matter is, when you really look at the mining statistics, mining has flatlined over the last 10 years or so. Mine outputs kind of consistently went up and up and up until about 2000, and then they started to just kind of flatline. And some people speculate that we may be close to what is known as peak gold, when the amount of gold that's mined every year begins to decline. Because the fact of the matter is, the easy to get to gold has already been dug up out of the earth, so it's more difficult to get the gold that's left. So what I'm getting at here is, don't let these stories fool you. Gold is scarce. Gold is valuable. Gold is going up. We're in the middle of a massive bull run. Your dollar is depreciating. You want some gold. You do, right? The fact of the matter is, we live in a fiat world where your dollar is depreciating. It's losing value every day, and you want to have real money. Gold and silver are real money. And, no matter what the naysayers will tell you, it's a fact. We have 5,000 years of history backing this up. So now's the time. Now's the time to get your real money. And you can do it today. You can call Money Metals. You can talk to a precious metals specialist. The number is 800-800-1865. Again, I say this every week, but talk to these folks. They're fantastic. They're a great resource. They can help you figure out how gold and silver will fit into your investment portfolio. They'll help you figure out what products might work for you. They'll tell you about the different programs we have. Do it today. Make the call. If you don't want to talk on the phone, go to moneymetals.com. You can chat with a precious metals specialist online. Or if you know what you want to buy, you can just go to the moneymetals.com website and you can purchase whatever you need right there. We'll ship it to you, or we can store it in our own vault. But do it today, right? We're at record highs. I think we're going to see more record highs. We're seeing a lot of analysts talk about $4,000 gold. So there is still money to be made. And the fact of the matter is, the government is always going to be devaluing your dollar, which means the value of your gold is going up. So with that, that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up and join the 1 million people that are already on our email list. Yes, 1 million. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. This week, you're going to be able to hear our CEO, Stefan Gleason, in an interview that he did. So be worth checking that out. Thanks again for listening. I say it every week. I really do appreciate you taking time out of your day to listen to the show. If you like what we're doing here, please go and like the podcast on your platform. Give us a good review. Share the episodes. It really helps spread the word and makes the show that much better. Again, thanks for listening, and I'll be back again to talk to you again next week.